Good day, everybody, and thank you for joining us today. This will be our Q1 2025 fixed income review. My name is Murray Anderson. Joining me today on my left is Michele, Vishal, on my right-hand side, Bastian, and another Michele. Guys, welcome. Thanks very much for joining today. There's lots to talk about in the fixed income world, and particularly what's been taking place over the last couple of months, particularly post-Independence Day. Lots of exciting market volatility that we can talk about, and no doubt lots that's been keeping us awake and aware of what's been going on around the world. So to kick off, Bastian, as CIO, can you please lead us into what's been going on over the last couple of months?
Yeah, thanks, Murray, and thanks everyone for joining. I guess it's easy and quick to just jump into Trump and the tariffs. That's what obviously been driving markets. I think there's a lot more going on, but we have to focus on that in the beginning. And our take is that the whole Trump presidency so far has been a tale of two halves. So we started off with actually quite a lot of business optimism, consumer optimism, market optimism around potential deregulation, around potential tax cuts, potentially boosting private investments or like investments into infrastructure, investments into even like heavily the IT sector. So all of that came quite positively and markets took it positively and rallied, but that didn't last too long. I guess the tone shifted quite quickly towards tariffs and towards also like, more immigration constraints. And we haven't seen any tax cuts, we haven't seen any deregulation, so that negative tone has taken hold and markets eventually lost confidence, and we can track that, what we now would describe as a confidence crisis with weaker business confidence, weaker consumer confidence, and weaker investor confidence.
So Bastian, I think what you're saying is we thought it was going to be business friendly, very quickly became business unfriendly. And I like to term the economic washing machine was turned on and everything was turned upside down, which is obviously very interesting. But I think the big particular point to focus on is, what happens with US growth, and particularly with all these trade tariffs coming in, what happens with global growth. And that obviously has a massive bearing on asset prices and how we manage money on behalf of clients. So can we talk about global growth and where we see particularly US growth going?
100%. So to start that off, I guess the key thing is to just see top down, the US economy is very consumption driven. So there's 70% of the US economy is driven by the consumer. So if the consumer loses confidence, businesses lose confidence, investors lose confidence, investors will stop investing, businesses are put on pause, so to say, and the investor stops consuming. And that's eventually taking a toll on US growth, and the US being basically the engine room of the global economy, that eventually takes a toll on US growth. Okay, so we start by looking at the Prescient economic indicator and its inputs. And I mentioned how heavily consumption driven the US is and the US consumer driving it, and also business confidence or consumer confidence in this instance driving the consumer and the consumer behavior. So to just see how we proxy that, when it comes to personal consumption expenditure, we proxy that by looking into all the individual data points which go into our engine room, our Prescient economic indicator, which would be the total vehicle sales, new home sales, housing starts, building permits, etc., etc. On the right-hand side, you can see the list. I'm not going to go all of them, but it really includes what we think almost everything. At the bottom, you can see retail sales is one of the most important ones. And those obviously heavily drive the US economy. If I just switch that off and look into consumer sentiment, you can see that there's quite a few surveys which we are using, which are proxying consumer confidence for us. And the biggest one is here, the Michigan consumer surveys, and that's the Michigan consumer sentiment, but also all the subcomponents of that survey, which we all use. Okay, so, and that's exactly what has been driving a little bit of a slowdown over the last couple of weeks. So if we just go into our approximation of US growth and where we see it right now, so you can see on the x-axis, just the timeline going all the way back into the 60s. The dark blue series would be the actual GDP prints, including the weaker print yesterday. And then we can see the Prescient economic indicator, which is the light blue line, which is our approximation. If I just zoom in on the right-hand side ever further and look at our point forecast, you can see that we can see quite a steep downward trend in this Prescient economic indicator, which is exactly defined by those elements which I described earlier. Right now, our cost is back into the positive. Now, that's mostly driven by the labor market report, which came in strongly last Friday. But that report pushed us just above the 0 line. The two knocks which we've seen here, basically the one being in the middle of March and the other one in the middle of April, those knocks have been driven by the weak outcomes from the Michigan consumer sentiment surveys, which I just mentioned earlier. So with that, a lot of room for a slower economy, a confidence crisis, so to say. And yeah, not a deep recession yet, but certainly going to be interesting to observe what's going to come in the months forward.
Thanks, Bastian. Thanks for that update. Vishal, turning to you, and I must rectify myself. I said Independence Day and not Liberation Day. But on the Rose Garden, Trump was talking about American exceptionalism and put in all these reciprocal tariffs, which obviously saw the bond market spike, which you'll cover, but maybe just reflect on the tariffs and whether we think these are actually going to bring the benefits that he so anticipates are going to.
So Basti sort of mentioned it, but the announcement of tariffs by President Trump has spiked volatility across the markets. We've seen that, at the core of the assumptions around these tariffs is the assumption that trade deficits imply economic weaknesses and trade surpluses imply economic strength. However, this oversimplifies the dynamics of international trade. If a country were to have a trade deficit, it implies that, or generally implies that they are saving less than investing, and not necessarily that their trading partners are taking advantage of them. So using tariffs to sort of reduce the trade deficit sort of just misdiagnoses the cause of it. And what it can actually end up doing is it can distort capital markets, the welfare, and also misallocate resources. Empirical studies actually show that on average, in general, that tariffs have almost no effect on reducing the trade deficit. So what we've seen is that there's been a decoupling of the relationship of the US dollar and the US treasuries. Generally speaking, with tariffs, the expectation is that US dollar will strengthen, given that the Federal Reserve will need to tighten rates to keep monetary policy in place. However, if we do look at the US Treasury 10-year, we get clues as to what is actually happening. So if we look at the US Treasury, we see that from Liberation Date, for that week afterwards, we see that the US 10-year has actually increased by about 29 bips. However, when we dissect that, we see that the normal term premium contributed about 37 basis points, and the average short term reduced by about 8 basis points. But the interesting part is that inflation expectations have actually dropped. So we see about an 18 basis points drop in inflation expectations. That's quite interesting in the fact that, the market is not expecting inflation to rear itself up from tariffs. So initially we were expecting to see inflation from tariffs, but then a drop off as consumption sort of falls off a cliff. We get disinflation and then minimal effect from inflation as a result. This is quite interesting in the fact that, we expect tariffs to have inflation, but the market really wants to be compensated for that policy uncertainty and geopolitical uncertainty that there is right now. And hence, we see this shift higher in the US Treasury yields.
Thanks, Vishal. It's very interesting looking at what happened in that you had the dollar starting to weaken, you had the gold price shooting up, and then you had, as you've reflected, the US long bond starting to rise, which in effect is negative for the US economy, the way I understand it, in that obviously the lending rate, the long bond, is where you price, for example, home loans. Now with that, selling off, it becomes more expensive for individuals to borrow or even companies to borrow. So, that started to look as though these tariffs were not going to be beneficial to the US. What's your view on that?
Yeah, indeed, right. We saw a sell-off in the back end of the yield curve. Normal term premium has spiked up, and it suggests that, the market wants compensation for the risk of uncertainty and geopolitical tension out there.
And I guess on that front is what we're saying is that through the data that you've just shown is this is not going to be inflationary long-term though, which is obviously not as contrary to what a lot of people have felt. So I think the other thing that we picked up, Michele, was sort of credit markets in the US were also starting to be affected. And a person in your space, in the credit space in South Africa, we also had a couple of additional issues to deal with, the budget, VAT increases, the potential GNU breaking up, that obviously affected South African credit markets. Maybe just a little reflect on what took place over the last couple of weeks.
Yeah, certainly very exciting and eye-opener. I mean, keeping us awake at night. A lot of drama, a lot of head news, headway, making us feel in terms of where's this market going. There's a lot of uncertainty. And so from our perspective, yes, the US Treasuries, we've seen a lot of sell-off significantly, but if you're looking at the credit market, actually it's been stable. We're looking at our data, our probability of default, that hasn't necessarily filtered through. So we're not necessarily, yes, there is heightened risk still within the market, but we're not actually seeing the probabilities of default falling off a cliff in order for us to change our investment view. It's still very much bedded within our systematic approach backed by data. And if I can showcase our CCI, which is our credit cycle indicator, if I can just talk through that, just to give us an indication of where the market is at the moment. So demonstrated here is our credit cycle indicator. Ultimately, what we use this for is a guiding principle to see what is the health of the credit market, or even how risky the credit market is. So the line demonstrated by the dark blue, that's our credit cycle indicator. As you can see, the last line over here, which is the end of March, indicates that there's been a slight increase in risk. So this is demonstrated, obviously, taking into account what Bastian and my colleagues have actually said. Business and consumer sentiment has been impacted, and there has been a sell-off in the market, and that's demonstrated in this curve. Over and above that, what we're also seeing is that investors are, again, wanting to be compensated for that additional risk, sitting, as we can see in the light blue line, our average spread. So ultimately, what we try to do from a process perspective is to, number one, look at the health of the credit market, how we should be positioned, coupled with the probability of default, and making sure that we are also compensated for that risk. So Mari, even though there's been a slight increase in overall, what we've seen in our credit cycle indicator, if we're looking at credit and the probability of default over time, we're not really seeing that filter through as yet. The market, from a credit perspective, overall has remained stable overall. And what's really coming through is that we still are able to get the yields and still beat our benchmarks, even though there's a lot of noise. We've built a systematic, data-driven process so that we do not focus on the noise. And so from an investment perspective, our views are bedded on the data, and the data is showing that credit is still very appealing. You can still get yields that are quite decent, 10, 11% all-in yields. And so even though we rate over 300 issuers, what's really important is that we are selective, conservative, and we choose issuers that are defensive in nature so that we actually, in the downside scenario, that diversification actually mitigates the noise, and then we can still actually take advantage of the upside potential,
And I guess the resounding point around that is that those corporates' balance sheets are still intact. They're still operating well. Even though there's a slight risk pickup, you're still confident that they're going to deliver, as you've said, on the yield. And therefore, investors are justified, for those that are prepared to take that level of risk, they're justified taking the risk with a commensurate increase in return.
Exactly, and our data actually helps us to screen efficiently and pinpoint exactly where are the pressure points. And then obviously that becomes an indication of, okay, so what is the appropriate yield I should be earning for this level of risk? So we've successfully been able to do that and demonstrated in how our funds have been performing.
Thank you. We'll come back to it a little bit later. Bastian, just turning back to the US market, which is a big driver of global economic activity, of course. So we've spoken about growth, but let's just turn to interest rates and inflation. So we spoke about this tariff, this dual tariffs coming in place should be quite inflationary, or could be inflationary, and we're saying it look through, it's not. But I mean, now Jerome Powell's being somewhat pressured potentially to cut rates. What's your view on the interest rate cycle in the US?
Yeah, we have to start with inflation to answer that. And I think inflation, right now, everybody focuses on the headlines, which is tariffs, tariffs, tariffs. So we do think we have to look beyond that. And for that, we really need to see what our short-term inflation expectations do and what our long-term inflation expectations doing. Then those are two different things. So what I mean by that is let's look at inflation top down. And this is inflation through time for the United States. You can see that we peak right up here at 9.1. That was basically in June 2022. And then we went all the way back down to 2.4, which was the last print. So after all, I might not want to say it, but inflation has almost been transitory. And before we go into the tariffs and the meaning thereof, let's look at the drivers of inflation, because that really paints a quite important picture, which we kind of start to lose track of if we only focus on the headlines. So you can see that two components here are quite important. The first one is the shelter component, remains the sole driver. So we haven't seen any price increases from tariffs printing inflation to come out higher. And then we also see the negative contribution here from motor fuel, which is starting to become ever more pronounced, deducting already 0.4% of the CPI print. And that's going to become more, because we know that basis effects will lead us to have an ever bigger decline of the oil price featuring in the inflation print. What I really want to do now, though, is to decompose the inflation prints a little bit more detailed, and once again focus on those two core drivers. So once again, in purple you see the shelter component, which is shrinking quickly. So if you look at the size of this area chart, that the size of these bars, they're coming in quite quickly, and that remains the sole driver. Just for illustrative purposes, I could switch that off for a second. You can see that then there wouldn't be too much inflation left. Another component to focus on is motor fuel, which is this part on the left-hand side here, which is quite volatile, this kind of pinkish area. But you can see on the right-hand side that it starts to come in. So it starts to detract ever more from the inflation print. So just before I go into the tariffs now, there are also structural forces or cyclical forces, if you want to, which are driving inflation to ever lower levels. We are already at 2.4. So the fears about inflation might be overblown in our opinion. I want to now move into inflation expectations, and that's really where we're going to speak about tariffs. So the first chart just very briefly shows US CPI in the dark blue line coming off. It's just a different x-axis here. And then the 1 year inflation swap. So that's the expectation of inflation 1 year out. And what you can see is that inflation expectations have indeed risen. This is because we are looking at the 1 year inflation swap. So over the next 12 months, no surprise, we will see a little bit of an uptick in inflation because prices will go up. And we know that by now. But is that really a problem? For that, we have to look through the short-term noise and more into the long-term. And what I'm going to do on this chart is just once again bring in the 1 year inflation ticking up. Okay, so 1 year inflation expectations in dark blue keep on rising. But then more importantly, if we look into the 5 year inflation expectations, they've actually been trending down, right? And that's absolutely crucial. Can bring in the 10 year if you want to, and you see the same picture. So long story short, we have to differentiate between short-term expectations and long-term expectations. And the short-term expectations just on the 1 year are ticking up slightly, while the longer-term expectations are coming down quite sharply. And the Fed should supposedly look through the short-term noise and focus on the long-term.
Thanks, Bastian. Insightful decomposition of the inflation outlook. And if that's really expected to be long-term anchored at around about 2%, what does that mean for US inflation, interest rates over the short and longer term?
So I think that's where the story has become slightly different to South Africa now. And Michele is going to speak about that just now. But the Fed is set to be waiting and seeing, and they don't really have to cut because we see the hard data coming out strongly. We don't entirely agree with that view. It's risky to just keep on waiting because monetary policy operates with such a large lag, right? So with that, if you just keep on waiting until things break, you'll be too late. You'll be behind the curve. What we can see if we look into market pricing, though, is quite evident that over the short term, until we see the impact of tariffs, until we know whether Trump is going to flip-flop again and again and again, until we see the impact of that, there will probably be a little bit of a waiting period. So that means that probably only later this year there will be the first cut in the States. That's what the market is telling us. But then after that, interestingly, all the way from, let's say, Q4 this year until the end of Q1 next year, we are actually priced for 4 cuts. And we do think that's quite realistic, that eventually rates will come down from these 2 high levels.
Okay, thanks, Bastian. Michele, turning to you, with the Michele on the right, Michele on the left, which is great, not to leave you out. As part of the cash and income team, we've spoken about US rates. Domestically, rates have also been higher. What's the outlook for local rates given what we're seeing in the global context?
Thank you. Thanks, Murray. Just looking at our local rates on the front end and what is forecast for interest rates going forward. We saw quite a low inflation print in April for the March inflation at 2.7%, which was well below expectations of 3%. And thereafter, we did see forecast for interest rates fall quite a bit. This was also driven by the much lower oil price that Bastian has mentioned. And we've also seen another comment from the Reserve Bank at the March MPC meeting. The Reserve Bank lowered the inflation forecast for 2025 from 3.9 to 3.6%. So quite a bit of more sort of lower forecasts for inflation going forward, especially over the next year for 2025. I'll just quickly show that on a chart. Let's just turn our view to what is actually priced in interest rate markets over the forecast period, which is 24 months. We're now looking at the forward rate agreement curve, which is commonly known as the FRA curve. And this just shows how interest rate cuts have now come through compared to 1 month ago. We're expecting more flat rates going forward. And now we've seen 2 interest rate cuts over the next 6-month period. So up to November, the market is expecting 2 25 basis point cuts coming through in our local market.
Thanks, Michele. I mean, I think we all look forward to 2 cuts at some point in the year for those of us that are funding home loans and other expenses. But I mean, interestingly, that has an impact on fixed income investors, which we'll come back to a little bit later from a fund positioning point of view. But I think again, off the back of what we're expecting from a US cutting cycle, we will follow tandem. Vishal, that comes back to the bond market. And again, particularly we spoke about the volatility we had seen in the US long curve. I mean, the South African market reacted similarly. Give us a reflection on what took place and what did the team consider doing over that period?
Thanks, Murray, for sure. So our bond model was in a neutral state at the beginning of the year, but then, as you mentioned, subsequently we saw tariffs coming out of the USA and then also the GNU, where there was uncertainty whether there was going to be a collapse in it. Our bonds call then shifted to moderately positive, strongly positive, and I will now show you how that has been occurred. So as mentioned at the beginning of the year, we were in neutral state. This call, however, shifted to strongly positive, moderately positive. The main driver behind that is the valuation pillar, where initially at the beginning of the year, the SA real yield, relative yield, and SA term premium were a lot less blue or lighter blue shade. These have now turned navy blue, suggesting that or showing that the yields have indeed shifted higher and are at attractive levels for investors to jump in. If you compare the spread between EM yields and that of the US, that spread is still very attractive. Looking at the term structure as well, expectation, as Michele mentioned, is that the front end will remain fairly compressed. The back end will shift higher. However, that's of term premium and not of tighter monetary policy. We suggest that we won't see any bear steepener or aggressive bear steepener taking place. This sort of aids the cause for holding duration, which is what we have indeed done, which I'll show in a moment. The other pillar that sort of works in tandem with valuations is financial conditions. But as mentioned, we've had a weaker US dollar. Also, the US term, the slope hasn't shifted aggressively to high, and these pillars have sort of added to the value and not detracted from going into moderately positive or strongly positive, which we have indeed done. In terms of how we have positioned ourselves, at the beginning of the year, we were more in the belly area curve, between the 32 to 37 area of the curve. We've looked to add duration and now hold the 2040 and 2044 bonds to take advantage of what our score is suggesting out there right now.
Okay, great. So quite an active period then, moving from the belly of the curve to the longer end to take advantage of those cheaper prices. I mean, if you consider what domestic bonds did last year, it could be another good year for the bond market domestically. So you are advocating longer duration in portfolios, I guess. Okay. Good stuff. Michele, turning to our income portfolio, the domestic income provider fund. Over this period of fluctuation and the expectation of rates, how's the portfolio structured? What has the team been doing to take advantage of these movements? And what can we expect from income provider?
Sure. I'll just take you straight through to the portal to just show you our positioning within the portfolio. Okay, turning to our internal portal, having a look at the positioning for our income provider portfolio. The current forward yield is at 10%. The fund NAV is at 41.5 billion and the current duration at 1.356. Just looking at the actual positioning, so within the first quarter of the year, we added our exposure on the fixed govie bonds. We increased our exposure to the 2032s. On the govie curve, this was showing the better risk reward within the duration we needed to add within the fund. The rest of the makeup of the fund is mainly invested in floating rate instruments. And as Michele mentioned earlier on, we always aim to diversify our portfolio. As you can see by the building blocks within the fund is currently made up of quite a wide range of different assets and asset classes.
Thanks, Michele. A 10% yield out of an income fund with diversified risk. I mean, we always talk about the focus of income provider protecting capital on a 3-month rolling period. I mean, I think that's reflected in the allocation that you demonstrated. So that's still in place, which is good. I mean, I think a 10% return from a fund is not a bad yield pickup above money market, for example. And so, if I think about where to next from a product point of view, clients looking to achieve a higher yield would go across to our Income Plus portfolio, which adds more credit to the entire portfolio, being a credit fund. Michele, would you want to pick up on that and just talk a little bit about Income Plus? I know we spoke about credit markets and where we see them, but how does one get a little bit of extra yield from 10% and a little bit more out of the Income Plus portfolio?
Yeah, certainly. It's definitely a fund that we are proud of, and we've grown over time. It's sitting above the 5 billion mark with a 5-year track record, quite impressive. And so ultimately, the only way we can achieve this is having a robust process, right? And having a team to back that. So ultimately, if we're looking at the fund, which as at the end of March, was able to achieve a yield of 10.86. Now, that's quite impressive. And if I looked at the latest, which was now the recent point, as at May, we're achieving above 11%. So much like the positioning in terms of the house where we moved to longer, switching out some bonds to the longer end, Income Plus has also followed suit, but also we've been able to take advantage of the ability of the fund to be flexible in tapping into other building blocks, other asset classes. So a mix of fixed rate notes, floating rate notes, but also structured products, for example, such as your credit linked notes, where you can actually pick up additional yield. So there you can be earning your 12%, for example. And so while the credit market has been quite quiet over the last quarter, the team's ability to originate and actually go out and find opportunities in a market that is filled with uncertainty, we're able to still get good quality assets and put that into the fund. That's been demonstrated in how we position the fund and how we've been able to beat our benchmark over the last 5 years, ultimately. One might ask, okay, so how do we do this? Yes, number one, diversification, backed by risk management, robust process. Number two, we do take ESG into account. It's integrated actively into the decision-making process that is backed by data again. And then over and above that, we are very selective in terms of our credit selection. So that's how we're able to get the yields that we do have for our clients. So, I mean, if I were to, it's simplistically saying why this is a compelling fund for a retail investor or the like, is number one, it offers that consistency that stability. It's embedded in risk management. And at the heart of what we do is not only risk management, but capital preservation. Here you're able to earn your higher yields, but you still have that stability, that consistency of the fund that's able to. It also gives you a higher enhanced yield other than cash or other more conservative products that are out there. So simplistically saying, it is a great fund. We've been able to demonstrate this over the 5 years. Of course, with credit, there is risk, but it's ultimately what is the process? And we've been able to demonstrate quite a good track record of why it works.
Thanks. I think the point around that is, what you're emphasizing is if you want to take that additional return, you can get it, you'll source it through the assets that you'll find. But I think, again, it's from a client perspective, it's the positioning in a portfolio and sizing that opportunity appropriately in a portfolio, which gives you the pickup, which is great. So we've spoken about income provider, 10%. We're talking about 11, 12 here. Vishal, if we go back to the bond market, what would you expect for the next 1 year out of a flexible bond fund or a portable alpha bond fund in terms of returns?
Yeah, sure. Right. So, the ability to calculate expectations actually fits perfectly into a systematic investment house. We're able to look at past events and where yields were in the past, and then to sort of ascertain what we expect over the next 12 months. We're able to do that, and on average, we expect across the term structure to get about 13 to 14%. For an investor looking to gain exposure into normal bonds, we have two distinct propositions for them. So if you are sort of ability to invest across the term structure, not worried about being benchmark cognizant, you're able to have tracking error in your portfolio, then the flexible bond strategy is for you. I say, you could at any point in time be, let's say, 80% invested in cash, 20% in bonds. So if that is your concern, then the flexible bond strategy is for you, because you want to sort of have the best in ideas strategy. However, if you are more benchmark cognizant, you have tracking error limits, and you need to have 100% exposure in bonds, then the portable alpha strategy is the investment for you. So you'll get exposure to the OB benchmark, but then it's also overlaid with our bond portable alpha strategy.
Okay, great. Thanks very much. I think before we close, let's start with you, Michele. Let's just have a wrap up of the last quarter across the income funds that we manage. If I can start with you talking to income provider.
Sure. Thanks, Murray. Just looking at our, how we position income provider in the first quarter and our risk-focused approach of not having a negative return on a 3-month rolling basis. This has really come through with our performance in the first quarter. The fund managed to return 174 basis points, with the All-B did 70 basis points in the first quarter. With this, it's actually put us in the first quartile for 2025 so far. And in the 3, 5, 7, and 10 year, we are ranked either in the first or second quartile for income provider.
Cool, fantastic. Michele, Income Plus?
Yeah, we've weathered the storm, if I can say it that way, and that's ultimately speaks to our diversity, right? If we're looking at our on the quarterly basis, we came in second quartile, and if we're looking at 1, 3, and 5 year, we were actually first. And if I just look at the 1 year return, over 12% we were able to achieve. So I think the positioning and our strategy of how we position the fund definitely has showcased through the noise.
Well done. Vishal, bond space?
Yeah, as mentioned, by adding duration over the first quarter, we've actually been able to outperform benchmark and actually in the first quartile. And if you look over longer term as well, we are also in the first quartile. So yeah, good proposition and a good way to invest.
Oh, good. Thank you. Bastian, then to close, we've spoken a lot about the fixed income markets. There's a lot of noise still out there. How do we position ourselves, and what should investors be thinking about in terms of what they can expect from our fixed income range?
Yeah, one thing is for sure, the future remains uncertain as always, so we have to be cautious. I'll start in the global space. We don't like the tight credit spread, so we take very little credit exposure. We don't like that the yield curve is inverted, so we take little duration. And the sweet spot is still the very front end of the US yield curve, where it's quite attractively priced, but still quite high yield. And now let's see how long the Fed is going to be on hold, but the longer they are on hold, the longer we will earn those attractive rates. So that's quite attractive. In the South African space, the story is slightly different. So here we have a very skilled credit team on the ground, and we like the alternative asset classes of private debt, private credit in South Africa. They are a true diversifier, which is a big advantage also in our balanced fund, in our income provider fund. We use these strategies across the board, and they've proven to be a true diversifier even in periods where US Treasuries sell off and the dollar sells off. That's where those alternatives could actually shine, which is awesome. We are differently positioned in South Africa compared to the States, given that we actually have an upward sloping yield curve. We've got a lot of term premium to earn. So bond market, and Vishal spoke to it, it's attractively priced, so longer duration. So we have moved in our income funds, be it income plus or income provider, moved from like the very front end into like more the belly of the curve, adding a little bit of duration quite cautiously in line with the mandate. And then in the bond space, obviously, we've moved out further. So South African assets remain underpriced, remain attractively priced. And with that, that's how we gain the exposure.
Thanks, Bastian. One of our funds that we didn't talk about today was Global Income Provider. It's probably a topic for another whole webinar on its own. But I think to the point that you made is that fund concentrates on the short end of global fixed income assets. It targets US CPI plus 1%. So we're certainly aware from looking at the data, the CISA data that is in our industry, is that a lot of clients still like to take money offshore, probably more so when the rand strengthens. But should clients be looking for a global income fund, our Global Income Provider is also a solution we offer out there to investors going offshore. But folks, thanks for joining today and giving insights into the fixed income world. Folks, that's the end of our webinar. We will be taking questions and we'll move live to take those questions and answer them. But thank you for joining us. We always appreciate your time and look forward to seeing you all soon. Okay, well, here we are. Thanks very much again to my colleagues for joining me. Maybe just to ask the questions, we've had a few posted on the chat. But Bastian, I think just markets are very much aligned to a level of confidence. And I think certainly what we've seen over the recent past is we had a very friendly business environment when Trump came in, and that became very unfriendly through the tariffs. And we've seen, as we've discussed in the webinar, lots of sort of volatility and uncertainty. And the data started to look very soft and unpleasant. But things are starting to change. Maybe just give us a little bit of a view on this backdrop in terms of confidence and where we're seeing growth the next forward-looking couple of weeks, possibly.
Yeah, sure, Maria. I think that's really, what has kept markets in check is like this constantly changing tone from the US presidency, moving from, in the beginning, very business-friendly tone to a very strict on tariffs kind of standpoint. And that's what has moved markets, and it creates a lot of damage. And I think the key thing here to consider is that the damage is long-term in terms of business confidence, consumer confidence, and investor confidence. So even with the tariffs, and we're hearing it this morning, being massively, dramatically removed again, almost taken out entirely, it doesn't mean that business confidence jumps back immediately. So the challenge will here be, once again, will the hard data as usually follow the soft data, and where are we going with it? So far, the hard data looks very strong. The soft data looks horrific. I can't put it differently, but it looks like that the soft data might now also improve. So there's a lot of question marks, but we have the tools and the surveys and the measures to track all of this in real time quite well.
Thanks, Bastian. I think that also then just relates to interest rates. I mean, obviously the pressure, as we mentioned in the webinar, and people know well, is that there's been this downward pressure from on Powell to cut rates, which he hasn't done, and probably that's not a bad thing given what the uncertainty we've seen. But I mean, just think domestically from a rates perspective. Also, we anticipate a cut locally. I mean, the South African consumers under massive pressure. Funding rates are still high. Business confidence has been somewhat under pressure, or uncertain about what to do given the high interest rate environment. Where to for domestic rates? What does it mean for us?
Yeah, so that's a good point. I guess quite a different scenario to the States, where we have a little bit more inflationary pressures and also like a little bit more, and even if the economy is slowing, still like economy which is closer to working at full operation. And we're not there in SA, we've got a massive output gap. So in SA, we've always been scratching our heads over the last couple of months, why do we not eventually cut interest rates? So where to from here? I guess if the Fed would cut, it would be easier for us to cut as well. But with the last inflation print last month at 2.7, that's now meaning that we're really falling out at the bottom of the lower line of the band. And with that, we are now priced for the end of May for the first rate cut, and I'm pretty sure that will come. And then we priced for another cut, 25 pips at the end of July, which means basically 2 cuts in the next 2 meetings. And we think those are now very, very likely to actually finally materialize.
Thanks. We've got a question on the bond market, but before we come to that, Michele, this cut in rates, is that going to be good for credit markets?
So, Murray, yes, definitely. Short answer is yes. If you think about a lot of the credit notes out there is travel linked, and so with the rate cut, obviously that would be beneficial because the cost of capital ultimately for borrowers will be it will ultimately be cheaper, right? And this will mean that they're able to raise funds on a cheaper basis, ultimately leading towards stimulating of activity, market activity, driving demand. What also could mean is from a probability of default also eases that, so that's positive. From a debt servicing perspective, so your interest rate coverage ratios, for example, all that will basically be eased from a debt burden perspective. So that ultimately all lead to if you think about it, the economics will improve from a credit perspective, but also it could lead to boosting liquidity. So cost of capital will be cheaper. There'll be a move away from cheaper kind of other alternatives and a move towards credit, ultimately, looking for that yield enhancement. Yeah.
Okay, great. I think that has an impact on all fixed income portfolios. Maybe a little bit later we'll come back to what it means for the funds themselves, an income provider I'm thinking of. But just as I said, we'll go back to the bond market. So just the 2 questions that are linked here. So I'm going to try and put them together and just give everybody a sense of the context of the SA government bond. So we had mentioned in the webinar that our tactical approach had been to move into add duration, which has been a good thing. But the questions really relate to, I guess, the sustainability of the South African growth story. There's questions around the employment in South Africa. Are we not borrowing too much? And then importantly linked to that is this political risk and obviously all these fiscal issues that we face in South Africa. So Bastian, maybe just unpack that, because I think this correlation in one's mind is, oh, South African government bonds are, we've got all these risks. Are they not too risky to invest in?
100%.
Maybe just talk a little bit through.
No, definitely. So we don't think, we don't think they're too risky at all. We do think they're quite a safe asset, to be honest. Of course, there's a fiscal challenge which we are facing, and I do agree that the government debt has been creeping up and creeping up and creeping up, and budgets have continued to disappoint on the downside. But that is disappointing. And it's not just the fiscal situation, also the general political uncertainty, which is worrying us. But we need to cut through the noise and look beyond the headlines. So what we must understand is that a South African government bond will pay us a certain yield, assuming that you get your capital back and assuming that your inflation doesn't spike, right? Both of these risks, those are the core risks. Both of these risks are quite muted because we see that they are well in check. So long story short, the government is already priced to default, but it will not default because we can just print rands. We've got only 25% of our debt held by foreigners. So for us to default is almost impossible. We can just print money. It's as simple as that. What would that mean? It would obviously leave inflation spike. So that takes us to a second risk. If we just print money and eliminate the problem through that, would create a lot of inflation. Is that a risk which is seen right now? Not really, because our forward-looking inflation metrics are super low. For the next 2 years, they're way below 4%. And I mentioned the last inflation print was 2.7. So inflation is actually lower than it should be. So with that, we're arriving at a real rate, which is exceptionally high. So we showed it in the webinar. Most of our bonds at the back end still give us 12%. We have an expected return, including the roll down and some yield compression of 14%. And then you've got inflation at 3%. So the answer is no, they're not too risky. Are we worried about the fiscal situation? Yes. Are we worried about political risk? Yes. Are we worried about the high unemployment in South Africa? Yes. All of that worries us quite a lot, but we get a lot of compensation for that, and we can measure that. So hence it was, we think, the right move, and the market is telling us it was the right move to basically inflation.
Bastian, thanks. And I think also one thing that we haven't seen is we used to have a very high participation of foreign investors in South African bond market. I mean, with higher rates, with potential return, that's quite attractive for foreigners to come into the market. Do you think that that's a potential catalyst to see yields move lower, which obviously if you're holding bonds, that's very beneficial from a capital gain point of view?
Most definitely. I mean, that is probably the key catalyst, right? So we've got 40, we have right now roughly 35% of our bonds being held by foreigners. It used to be about 40%, right? So they've basically cashed out. And if they cash back in and buy our government bond, that will immediately spark quite a bit of a rally, because that will be the massive demand compared to where we are now, where the bonds are mostly owned by banks, insurance, asset managers, and they're pretty full. So the next level of demand will have to come from foreigners, but given that they have so little exposure, that's quite possible. So what will trigger that? And the answer to that lies, as we think, in two factors. The first thing which comes to mind, once again, political risk. Do we hold the government of national unity together? Can we maybe just keep inflation in check and have a independent SARB and all of that? So that's the one factor. We look at our local factors once again, and we start to focus on that. So yeah, if we have attract more investments because of more political stability, that would be nice. That's one way to get that. I think a more likely way is, and it's probably the more important one, is that we eventually see interest rates move lower in the United States. And I'm talking at the front end of the curve, that eventually we see interest rate cuts. The interest rates in the States are way too high. So once they come down, then international investors will not be able to resist our juicy yields, so to say. So at least the hurdle to resist becomes ever tougher. So long story short, lower rates globally, a little bit more political stability locally. Those are the two drivers, and if you get any of those right, then there's a lot of upside versus government bonds.
Okay, great. So I think obviously interest rates for being cut. So we've had this high interest rate environment, which has been super beneficial for people that have had cash lying in the bank. We know that bank balance sheets have been swelling with about 1.4 trillion rands of assets lying on the balance sheet because of high interest rates. I mean, obviously the cutting cycle affects us in our portfolios. So Michele's spoken about obviously the benefits to an income plus. But if you just think about money market, now the rates get cut. So obviously income yields are lower. We go to something like income provider fund. The cut doesn't have such a dramatic impact on that because of the breadth of assets. And so the benefit there would be that we can still maintain higher yields. I know we're talking about 10%, but the dramatic, as I said, it's not as impactful. Yes, it does impact. But the forward yield on a fund like that would still look in the high 9s and 10s, even in a deeper cutting cycle. And on the other side, then it has a great benefit for the bond fund. So sitting in longer duration assets, if you were sitting in our flexible bond fund or portable alpha, you would again get the benefit there. So quite a nice shift. But what we recognize is that as these rates get cut, people need to take a little bit more risk to maintain their higher income levels. And particularly this has a bearing on conservative clients and all those in income portfolios.
No, 100%. So I think for income provider, the way we have positioned the fund is that we locked in some of these high attractive yields at the belly of the curve, if we may call it. There's quite a bit of a proportion of the portfolio. So we feel quite comfortable that if rates come down, or once rates come down, that we will see the usual effect in the fixed income market, yields down, price up. So we see a little bit of a price gain on the portfolio immediately. So it will be positive and it will help us. But the nice thing about the income provider strategy is we will then potentially have to reposition ourselves a little bit, but with the fund yields right now above 10, I mean, where will it drop to? It will then drop to 9.75 maybe, or 9.8. And then we see another cut and we drop to 9.7 maybe. So it will remain very, very attractive. And with that, the beauty of the income provider strategy right now is that there's almost no downside scenarios. Like if interest rates come down, we'll benefit. If interest rates don't come down, we keep on earning 10% with inflation at 2.7. So it remains very, very attractive in that space. And that's what we also said throughout the webinar.
Great. Folks, there are no more questions. I'd then like to just say thanks again to Michele and Bastian for participating in the webinar, and of course to all of you for spending time with us to listen to us, and for those of you that posted the questions. And we look forward to seeing you again on other webinars that we'll be hosting shortly. Thanks for your time.
Thank you.